Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I welcome YFP co-founder and director of financial planning, Tim Baker, to talk about 4 reasons you should have your financial planner manage your investments. And spoiler alert, beating the market did not make the list. As a supplement to today's episode, download our free checklist, What Issues Should I Consider When Reviewing My Investments? You can get a copy of that resource by visiting yourfinancialpharmacist.com/investment review. Again, that's yourfinancialpharmacist.com/investment review. Now, YFP Planning, our team of fee-only certified financial planners, pride themselves in helping clients manage their investments in a tax-efficient, low-fee manner. And while that in and of itself is a win, that's just one part of the financial plan. Our planning team that services more than 280 households in 40 plus states guides clients through the entirety of the financial plan, including retirement planning, debt management, wealth protection, and more. All centered around our philosophy of helping you live a rich life today and tomorrow. You can learn more about our one-on-one planning services by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, let's hear from today's sponsor, First Horizon, and then we'll jump into my interview with Tim Baker. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment on a home may take years. We've been on a hunt for a solution for pharmacists that are ready to purchase a home loan with a lower down payment and are happy to have found that option with First Horizon. First Horizon offers a professional home loan option, aka doctor or pharmacist home loan, that requires a 3% down payment for a single family home or townhome for first-time home buyers, has no PMI, and offers a 30-year fixed rate mortgage on home loans up to $726,200. The pharmacist home loan is available in all states except Alaska and Hawaii and can be used to purchase condos as well. However, rates may be higher and a condo review has to be completed. To check out the requirements for First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. Tim Baker, good to have you back on the show.
Good to be back, Tim. How's it going?
It is going well. We're going to be doing back-to-back episodes focused on managing investments. Next week, we're going to talk about RMDs, or required minimum distribution. So we're going to get in the weeds a little bit over the next 2 weeks, which I'm excited to do as we talk about some of the investing side of the financial plan. Tim, today we're going to talk about 4 reasons you should have your financial planner manage your investments. Now, before we get into those 4 reasons, I want to make sure we're all on the same page with what we mean by this. So having your financial planner manage your investments. Talk about this at a high level so we can have the right context throughout the show.
Yeah, and my attitudes have changed about this over time. And really this is because of, just working with pharmacists on their financial plans and, just some of the things that we've come up against with regard to being effective and efficient with the financial plan. So when we say, we feel that, your advisor, your planner should manage the investments, what we're talking about are, the investments that you're managing that you don't necessarily need to. So these are things like your traditional IRA, your Roth IRA, your brokerage account, old 401ks, old 403bs, TSPs, 457 plans. So these are things that you're not actively contributing to as part of like an entire employer-sponsored retirement plan. And what we found over the years, because I used to be more location agnostic, meaning, my viewpoint was didn't really matter where it was. We would either manage it or help you management. And, I think in theory that sounds nice, but in application, it's not. It's messy. There's lots of hands in the cookie jar. There's lots of moving pieces regarding to the financial plan that the investments are absolutely part of that. So, our belief is that if there are held away assets, so held away are defined, when advisors talk about this, are assets that are not at their
Mhm.
custodian. So we use at YFP Planning, we use TD Ameritrade, which is recently merged with Charles Schwab. So Schwab will be the predominant brand there. We feel that those client assets that can be managed by us, the advisor, should be managed by us. And we'll get
Mhm.
into a few reasons of why that is. So that's the held away piece.
So let me give a for instance to define these just a little bit further and hopefully put something that people can hook on to. So Tim, if let's say I'm working with Kroger Pharmacy right now and I've been with them for 5 years contributing to their 401k. And then prior to that, I worked for, let's say, CVS for 5 years. And once I left CVS, that money I moved into a traditional IRA. Let's just say for that example. So I've got, $100,000 in a IRA, and then I've got this, let's say, another $100,000 in my current employer, Kroger, with the 401k. So when you say held away, that Kroger, my current employer account, $100,000 would be a held away asset through my current employer and the contributions I'm making. And when we talk about today, managing why you should have your financial planner manage your investments, we're talking about that previous $100,000 that's sitting in an IRA that maybe I'm self managing right now, or it could be someone's listening, they have another advisor that's managing for it. But that's a differentiation we're making, correct?
Yeah, you're going to have held away accounts that some are going to be eligible to potentially be moved over for us to manage. So that would be like the
Yes.
old employer. And then you're going to have some that aren't because you're actively
Yep.
contributing to said account. So yeah, that would be the distinction I would make. Mhm.
Okay. So an assumption I want to put out there before we get into the weeds here is that when we say why we believe your financial planner should manage your investments, the assumption we're making is that planner, from our perspective, best practice is they're fee only with a fiduciary responsibility, and they have a really thoughtful approach to how they're managing their investments, which would include an investment policy statement, an IPS, where you're really spending time with the client to understand their goals, understand their risk tolerance, and all of that is informing the direction that we're taking with the investment. So let's spend a moment just to break that down a little bit more in terms of what is an IPS and why is that important, and obviously the context here of fee only as well.
Yeah, and an IPS is not something that every advisor has or even employs. I think regulators like this because it's kind of a set of instructions for them to see how they are managing client accounts. When I was in my first job in financial services, we didn't have an investment policy statement, so we knew
Hmm.
based on a risk tolerance assessment that we give them that they're conservative or they're a moderate or they're an aggressive investor, but that was essentially it. So we kind of had it in their file that was what they were, and then we would try to match up their portfolio as such. The way that we do it is before we invest any dollars on behalf of our client. So
Mm-hmm.
let's pretend that we move that $100,000 over to a rollover IRA at TD Schwab for us to manage for the benefit of the client. Before we do anything with those dollars, we essentially go through a risk tolerance and questioning goals about the investments, and we issue a investment policy statement. So this is something that we send to a client via DocuSign. And in the investment policy statement, it's essentially an executive summary,
Mm-hmm.
what the purpose of the document is. And it's really to kind of outline investment goals, expectations, strategies and responsibilities related to the portfolio. And it's to kind of create, reasonable objectives and guidelines in the investment of your assets. So we outline things like what was your risk tolerance, what portfolio did we agree to, what is the asset allocation? So is it kind of a moderate 60-40, or is it more aggressive 90-10, or an all equity portfolio? What is that investment objective? So
Mm-hmm.
is it, aggressive growth or growth with income? Are there any type of liquidity needs, any type of tax considerations that we should be aware of? What is the time horizon? So, if Tim, you're the client and you have 25 years left to retire, then the time horizon is 25 years. What type of accounts? A lot of our clients will have an IPS, an investment policy statement for retirement accounts, but they might have something that is related to a tax bomb or a more near-term goal. So we have a different asset allocation. So we kind of outline, what are the duties and responsibilities of, reporting. So I think one of the fears that people have if they're, having their advisor, manage their asset is that I think they fear that the money's not theirs. And, I say, one of the things that I'll say is that we don't have necessarily access to the money. Like we trade the account, but I can't go in there and say, "Hey Tim, you move from this part of Ohio to this part of Ohio." Like you have to do that yourself because they want to make sure that the chain of custody from, where they're sending account statements is not broken. We used to be able to do that in the, recently. So it's very, very much like we have very deliberate and specific responsibilities related to the portfolio, but we're not, it's not our piggy bank, which I think sometimes people get afraid about that. So we do, the custodian does all, kind of the reporting with statements. We talk about what our responsibility is with rebalancing, how often we're going to review the count, if we take discretion or not. And then part of our IPS is we kind of outline the different positions, that we're in. So we kind of go through, what's our large cap, our mid cap, and all the different positions that we're in related to the portfolio, what the allocation is, kind of some nerdy stock analysis, what parts of the world that we're invested in. So whether that's North America or Asia developing, Asia emerging, Latin America, what the bonds look like. So if they're AA or single A, we kind of show performance. So we kind of look back 1, 3, 5 years and show kind of the annualized total return, the risk, some charts. We'll show like what the income is on this portfolio. So it's kind of a look back in terms of what the yield is. The stress test, which is a big thing. So, in the subprime mortgage crisis, this is how the portfolio would react, or when coronavirus happened, or the tech bubble. So we kind of show some of the stress testing on that. And then the expense, which often is a huge driver in the overall ability for the portfolio to grow, is what does the expense of the overall portfolio look like. So that's our North Star, Tim. That's the kind of the document that we use to trade and manage the portfolio as we go here.
Yeah, and I think that's time really well spent, right? Because I think for folks, as you mentioned, especially I would say for people who have maybe not worked with an advisor before, who have gone through this type of process or experience where you have someone that is helping to manage your investments, this can feel scary. It can feel big. It can feel, at least as you hear for the first time, a little bit like a black hole. And I think when done well, right, and that's the backdrop we're assuming as we go through these 4 points here today, when done well, as you just described in great detail, there's a lot of time spent, a lot of thought, a lot of attention to make sure that there's alignment in the decisions that are being made. And obviously that's an important part of the trust process as you're working with a financial planner. And that should be something that you feel good about, number one, and that you understand, and make sure you understand as you're reviewing those documents and having the conversations with the planner.
Yeah, absolutely.
So with that in mind, let's talk through 4 reasons that we believe you should have your financial planner manage your investments. Tim, number one, perhaps most obvious on the list is, saving time. I'm busy. I don't want to have to worry about this. Maybe less stress involved as well. Tell us more about this.
Yeah, I definitely think it's a time thing. Obviously, this is something that, we often talk about less is more, but, I think having, your hand on the wheel with regard to this is important. I probably even more so than time is just the brain capacity, Tim. I think sometimes we often really undersell or overlook the things that drag on our mind, that don't necessarily need to. So, I always, we've kind of talked about how, the two of us were not necessarily the most handy people in the world. Could I go out and learn like basic plumbing and things like that? Yeah. But like, I look at that as like on my time off on the weekends or whatever, I would rather pay a professional that knows what the hell they're doing, that have done it, that, it's not their first rodeo, than me waste a weekend and either complete it at an hourly rate that is well below than, what I would make during my day job, or that it's half half done or not done, so that's the thing, is like
with some curse
with
words
a
along
lot
the
of
way,
curse
right?
words and stress and things like that. So that's just my mentality. And I think that becomes more of a thing the more you look at yourself as a professional, as pharmacists should, right? So
Yes.
to me, this is an area, we talk about this with like, small, it's kind of a no brainer with like small business owners. The first thing that probably needs to go is bookkeeping. Like it's one of those things. And I would
Yeah.
say that, the more that, you kind of continue on and accumulate wealth, like this thing, working with a coach, a planner is in line with that. And the management of the investments and kind of the stress of it should be delegated to someone else. So obviously, again, it assumes you trust the person, the team that
Yeah.
you're with, which is not something that I take lightly or anyone takes lightly. On our team take lightly. One of
Mhm.
the things that I really like about being a financial planner is that you're in that position of trust. And I think pharmacists can relate to that. And again, not taking that lightly, I think, is important. But just think about
Yeah.
the convenience and ease of management, paperwork that's involved. I would love to be more paperless than we are now. We're getting there, but it's a kind of a slow go. But kind of the ongoing account maintenance, rebalancing, and other strategies that you're going. If you can delegate that to others, I think that's a huge time savings, but just a brain capacity savings. And
Mhm.
then I think you see this with people in the accumulation stage, but I think even more so retirees. And I joked about this with my dad, like when he retired. So he was no longer doing his day job, and he knew that I was, obviously, building out my business, and I'm a financial planner. And it was almost like every time that we talked about the market. He's almost preoccupied this, and it was almost a substitute for his job, and his livelihood is very much connected to what the market is doing. But I think, like, if you're doing it
Uh-huh.
correctly, you want to inoculate yourself as best you can, and those near
Mhm.
term ups and downs should not really affect your
Yes.
overall well being. So to me, a lot of people miss the mark on that, and I think that's where a professional can help you as well.
Tim, that's a really good example, in terms of the retirement and the preoccupied nature of investments. It's funny, my father-in-law, every time we visit, this comes up within 10 minutes, right? We're talking about the markets, the trends. And I think it's just human behavior that, not only do you have more time available, right, than you did obviously than when you're working, but you're thinking about things like distributions and strategies, especially if you're DIYing this and not working with a planner, and the ups and downs of volatility, especially the period we've been in here the last couple of years, like that can weigh on you. And I think having someone in your corner, to help talk you through that, coach you through it, making sure that we're sticking to the plan and that we have accountability to stay to that plan, is important all the way throughout, but probably even more important in that time period where you just have the time and it's front and center, top of mind.
Yeah, and I probably should give my dad less of a hard time. He's probably just trying to find ways to, like, engage me and talk about my business and things like that. So, but I know it for a lot of retirees is
Yeah.
definitely one of the things that they talk about quite a bit.
Number two on our list is ensuring an integrated approach, right? That we're not considering this in a silo. Something we talk about often on the show, Tim, that it's really important when we look across the entire financial plan that, when we're looking at investments, retirement planning, debt pay down, insurance, any part of the financial plan, that we're really looking at it in its entirety. And we're not just focused on one part of the plan, perhaps at the expense of other parts. So tell us more here.
Yeah, and I think, just like we talk about systems of the body, like
Mm,
everything's interconnected. And I think one of the things that we've learned over, from my time at Script Financial and now YFP Planning is that, if we don't have the assets and the investment management integrated with the plan, it's almost like we're trying to fight with one hand tied behind our back.
yeah.
So what we're really trying to do here is see the full picture. So we want to make sure that the investment philosophy and management of said assets is aligned with your goals and your life plan. So I'm a big believer in purpose-based investment. So another buzzword, but what I often find with people that are coming in the door, or even like do it yourself investors, is I'll say, and obviously, like, Roth 401k, a Roth IRA, a traditional IRA, we know that those are for retirement, by and large. But I often will see, brokerage accounts and accounts like that. And I'm like, what is this money for? And it's like, well, I don't know. I'm like, well, what are we doing? Like, why do we even have it? So really aligning and drawing clear lines of distinction between, what this bucket of money is for,
Yes.
and executing to that. But probably, so you have that, which is kind of more, broad to the overall financial plan, but then making sure there's alignment with other technical areas of the plan. So whether that be debt, the tax situation, retirement, it could be estate and charitable giving. All of those things are interconnected. And I think if you don't have eyes on or hands on that, it makes our job a lot easier. So from the debt perspective, Tim, we know this with regard to, your, PSLF and non-PSLF, that these things are interconnected. And oftentimes they are disconnected if they're not managed, I think by a QB, one person that is kind of overseeing the plan. We know that tax is another thing. Is there synergy with the financial plan and the tax plan? By and large, most advisors will say, hey, that's a tax question. Go talk to your accountant, which is like nails on a chalkboard for me. That's one of the things that we do differently. We have YFP tax that, works in concert with YFP planning. So we have a CFP that is your financial planner that is working in tandem with a CPA, which is your tax accountant. So looking at things like, are we going to have a big refund, or are we going to owe a lot of taxes at the end of this year? What are the tax loss harvesting strategies? What are kind of, as we get more advanced multi-year tax planning? So it might be, bunching for, charitable giving. We know that retirement and the investment strategy is intertwined. So in the accumulation phase, which a lot of our clients are in, that's simply bucket creation. So having the different buckets, but then where are we putting different assets?
Yep.
So a lot of people don't think that, probably in your Roth, you need, your most appreciable assets, which might be small cap or emerging market, should probably go there. Where do we put, tax advantage, accounts? Is that in the brokerage or is that somewhere else? So just knowing, where to actually put the investments that you're putting in that bucket is important in the accumulation strategy, stage, where a lot of people overlook that. And then in the decumulation or the withdrawal strategy, whether you're using a flooring strategy, a bucket strategy, a systemic withdrawal strategy, all of these have rules, Tim, that are clearly linked to the traditional portfolio and how we either refill bucket one with bucket two, or refill bucket two with bucket three, or how we're gonna, with inflation and the gains on the portfolio, how are we gonna essentially send that paycheck to you in concert with Social Security in 2024? How do we create the floor? What are the tools that we're going to use? And then how are we going to, supplement from the investment strategy and give those dollars to you in retirement? And then just overall, how do we manage, the liquidity needs? So there's lots of things that happen in real time and over the course of many years that, if we're managing through the client by proxy, is a challenge. And we've had instances where clients will be upset because they're trading their own accounts. And this is related to tax, and they're generating lots of short-term capital gains. And then they're upset with us because our projections are off. And it's like, well, we don't have any visibility or vantage point of what you're doing in these accounts that we're not controlling or we're not overseeing for you. So, it's one of those things that, this is what we do. We do this for our clients, across the board, and we think we do it well. So, working kind of in that way, I think is important for us, and I think for the effectiveness of the overall financial plan.
Yeah, Tim, and I think for folks that are hearing some of these terms for the first time, right, when you talk about things like flooring strategy, bucket strategy, systemic withdrawal, we talked about this on episode 275 of the podcast, where we had a month-long series on retirement planning. And that episode specifically, we talked about how to build a retirement paycheck. So I hope folks will check that episode out in more detail. So that's number two, ensuring that we have an integrated approach. I think you explained that well, Tim. Number three, which is one that maybe our DIYers are gonna hate that we're challenging this, but this is avoiding behavioral mistakes and biases. And Tim, I tend to fall into this. I've come to appreciate where I need help, but perhaps some overconfidence and really understanding the behavioral mistakes and the biases that we may fall victim to.
Yeah, I often say that with investment, you often want to do the exact opposite of what you feel. But the statement that you have to make, even before you make that, is that investing is an emotional activity. It is. And a lot of that has to do with kind of our aversion to loss, and sometimes it could be also chasing, kind of a big payoff if we're doing things like chasing hot stocks. So the market volatility, I think, really plays on our emotion. And I always kind of joke, like, when the market took a downturn during the coronavirus or during the subprime mortgage crisis, as you're seeing your portfolio go from X to X minus, 30, 35%, you want to take your investment ball and go home, Tim. Like, it doesn't feel good to see your balance, kind of get sawed off like that. But it often leads to bad behavior. And, that's typically where we're doing things like, selling low and buying high. So when we sell to kind of avoid that pain, then we wait on the sideline and buy when the market seems like it's returned to normal. So all of that upside. And again, like, I think people don't see this in themselves. And I would say that, Tim, that this is true for advisors as well.
Yeah. Yep.
It absolutely is. But I would say that, if you're, again, I talk about this, related to any type of salary negotiation, the big disadvantage that you have as an employee of a company when you're kind of, or a prospective employee of a company, is that, you might have a dozen times during your life where, you're negotiating on your behalf with an employer, whereas your counterpart, whether it's a hiring manager, an HR manager, they might do it a dozen times, like in that week. So you're at a disadvantage just because of reps. So I'm not saying that we as humans or as advisors, we don't have these. It's just that I think we're more aware of it, and we try to, mitigate that with the way that we build out our portfolios. So the behavior thing is huge. And that could be, again, it could be chasing hot stocks. It could be trading too much, trying to time the market, which we sell, we talked about the buying high and selling low, ignoring diversification. That's another issue. Sometimes we see, portfolios that are overloaded in tech stocks or one particular security, or even act on unreasonable expectations. I still, frequently will talk to people who are super confident in their prowess as an investor, but then will say things that just are not in line with reality. Like, hey, within the next year, I really want to start making passive income off of my, my portfolio. And I'm like, that's not a real thing in any, in any time in the near future. So we have to be aware of our common biases. And I think a lot of the ones that, that you mentioned are things like overconfidence. I probably see that the most. Typically that is more male than female. It's just the reality of the situation.
Yeah.
But even things like hindsight bias, like, of course the market went down and this is why, or herd mentality or overreaction. These are all biases that I think that we don't see in ourselves that really can affect our ability to grow our portfolios consistently over time. And we always kind of cite Vanguard. Vanguard has done an advisor alpha study. So it's essentially, and Vanguard doesn't have advisors. So they're kind of, they don't necessarily have a horse in the race, but they basically said that, an advisor can add 3% per year in, kind of return to your assets. Half of that, Tim, 1.5%, I think it's 2.9, or it might be 3, but essentially half of that, Tim, is related to behavior. And Paul Eichenberg, he kind of talks about, like, he does manage some cash or some investments himself.
Yeah.
But he's basically said, like, the core of his investments, what he talks about is there's a wall between him and his investments, and it's just so he doesn't do anything foolish or crazy. And that's part of this as well, is sometimes something, it's kind of the overreaction. Something happens in the market, and it's like part of our job is to say, hey, we're okay here. Let's continue to, execute to the plan that we have in place. And the behavior and the emotion drives so much of this, and it can either be bad behavior or, you can, again, delegate that out to someone to help you with that.
Yeah. And I think, Tim, the time we're in right now with the volatility, we talked about this a little while ago in episode 213 of investing considerations in a volatile market, but we are living it firsthand, right? The ups and downs, the announcements from the Fed, the anticipation, the reaction to that, the inflation numbers. I mean, it's just June. And, more than ever, I think there's that risk of access to information, volatility, on top of that. Obviously, there can be some fear that's layered on top of that as well. And all of a sudden we're feeling that itch to make a move, make some decisions, move our investments. And obviously there's tax considerations, there's, timing of the market. You talked about that considerations that can have a negative impact as well. So great explanation there. Number 3 on the avoiding behavioral mistakes and biases. And number 4, probably the favorite of our team, right, Tim, as it relates to cleaning these up, is avoiding some of the technical mistakes. And you've talked about this at length on the show as it relates to backdoor Roths and some of the mistakes. And I think one of the challenges here, and we even talk about this behind the scenes, that, we love putting out content and education. We do a lot of it. But as I often say in presentations, one of my fear is that I'm oversimplifying information to try to explain and to do in a short period of time, and that someone may make some decisions and maybe not have, the full understanding. We just saw that, as we talk about some of the changes that are coming to tax laws and different things, we may not understand the whole picture. So talk to us about avoiding technical mistakes and some of the common ones that we see here.
Yeah, I mean, at its most base, sometimes it's just understanding what accounts that you have. I still hear, investors that'll say, like, I have this, mutual fund account. I'm like, well, a mutual fund isn't an account, it's a type of investment. So that's at a very, extreme. But then understanding what are inside of those accounts, those investment accounts, which could be a mutual fund, an ETF, a stock. And again, this is not to belittle anyone or make anyone feel bad. Again, I always joke that, when I first got out of the Army, and I was picking the investments for my 401k, I looked at, all 50 investment choices or whatever, and I'm like, Investment for Dummies. And I bought that book and I read a few pages and I'm like, no thanks. And I just, picked whatever. So, this isn't something that necessarily is, we know this, Tim, it's not taught in school or anything. So it's not to make anybody feel bad. It's just that, this is what we do. So it could be, the types of accounts that you have, what are in those accounts, transferring accounts wrong. So, sometimes this happens where, accounts are moved between custodians and they're not performed accurately. And that could cause a lot of problems. You have the hyper investor. So it could be someone that's trading in and out of positions that's triggering short-term capital gains tax. And then we have issues with the tax bill at the end of the year or other things that are going on. I've seen portfolios that have 20, 30, 40 positions. And I'm like, what the heck is going on? Like, what are we doing? And, what is the goal of this, and sometimes it's just, I heard a stock or I heard this and I just bought it. Yeah. Over concentration. So that's a, technical mistake. Is there too much cash in the accumulation, too little cash when you're in the withdrawal stage? But yeah, one of the things that you're talking about that I think is, again, we gloss over is like just things related to backdoor Roth. Most of the people that we are working with are in that Roth IRA eligibility phase out. So even us managing this as a team it's a project. It's something that we have to be on top of. And it's difficult to do when you have to factor in phase outs, pro rata rules. You have to look at other accounts that you have, the step transaction rule. There's lots of things that go into that on the technical. I always joke, like, when I, kind of related but unrelated, Tim, like when I lived in Ohio the first time, I'm like, there's no way that I filed my own Ohio taxes correctly. This is impossible.
Especially in Ohio.
There is no way that I did it correctly because of the nuance there. And even and it, some of this stuff is kind of in the same breath. It's like there's no way that if I was kind of had a similar savviness with regard to investments and that I did back in the day, that I would be able to do this correctly without mistake. So there could be mistake with RMDs for retirements, obviously fees and things like that that are less technical but more kind of an awareness thing. So the list is long with regard to this, and again, what often happens is we read a blog or a podcast and we say, hey, that's really easy, and then we do it, and then the reality is that it's much more nuanced than it depends on your particular situation in terms of how to execute some of these strategies.
So Tim, we just talked about 4 reasons that you should have your financial planner manage your investments, and what's not on the list perhaps is something that everyone listening is thinking about of, hey, I'm going to have my planner manage my investments so that I can beat the market, right? Isn't that why I'm hiring you after all? Where's that on the list?
Yeah, I mean, I think it's not on there. And I think the reason, Tim, is that in order to beat the market, in order to beat the S&P 500 consistently, and there's still no guarantee of that, is that you have to spend so much time, effort, energy, and money to do that. And they say we look at the most active mutual fund managers out there, and by and large, the research and the studies show that though that type of active management in an effort to beat the market does not pay off, and on a consistent basis. And the strategy that we employ, that I feel like a lot of fee only, financial planners employ, is more of a passive buy the market, don't try to beat the market. The market will take care of you if you invest in it consistently without bad behavior over long periods of time. So it's more of a singles and doubles approach versus I'm going to hit a home run in 2023 and then strike out for the next 3 or 4 years and then maybe hit a home run in 2026, 27. So it's kind of the singles and doubles approach to invest in, and over time, I think that's a good equation for success.
And we're going to talk more about that. We have an episode planned for the near future on passive versus active investing, so we're going to dig into that a little bit more detail in the future. Tim Baker, great stuff. And for those that are listening to this episode and would like to talk with us about the financial planning services at YFP Planning and what we offer, obviously, we've talked about managing investments, just one part, an important part, but just one part of the financial plan. We would love to have that conversation. You can book a free discovery call at yfpplanning.com. Again, that's yfpplanning.com. Whether you're in the early stages of your career, in the middle of your career, nearing retirement, whether you have an advisor, you don't have an advisor, we'd love to have a conversation to learn more about your situation so you can learn more about us and determine whether or not what we offer is a good fit. So again, book a free discovery call at yfpplanning.com. Tim Baker, great stuff. And looking forward to talking about RMDs next week.
Thanks, Tim.
Before we wrap up today's show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists and the YFP community have taken advantage of First Horizon's pharmacist home loan, which requires a 3% down payment for a single-family home or townhome for first-time home buyers and has no PMI on a 30-year fixed-rate mortgage. To learn more about the requirements for First Horizon's pharmacist home loan and to get started with the pre-approval process, you can visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your